Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. And welcome back to another week of Bondcast, another week of yields moving higher and steeper curves. And Theo, I'll start with you this week because I think just last week we were talking about how you'd updated your gilts forecast for 10-year gilts. And this week I'll give you the glory of being allowed to celebrate that you hit that target. So what are you thinking from here, and what's the kind of main topics of discussion that you're thinking about for the UK this week?
Sure. Thank you, Imogen. Very, very kind of you. I think it is interesting that the sell-off has happened at a fairly fast pace. So we've reached 0.75 yesterday, and as of today, so the 24th of February, we are easily at that level. I think what is interesting is that the UK keeps underperforming other markets. So the story of UK being the one that leads in the sell-off still is there. We continue to see the repricing of that low for longer in the UK that is being taken out. I think what is very interesting is also what happens with with expectations and thoughts about supply. And this is also, something that for us it's important what's going on with the budget. So as things stand, probably there is good reason still to be short UK rates. Probably the high will be somewhere between 0.75 and 1%. Now, it is difficult to pinpoint that because we will be looking for a level where the market can be oversold, and at some point valuations will obviously be stretched on the other side. But from a long-term point of view, we are not very far from fair value. So the bigger question is, how much does the market go stretched and cheaper now? And whether with regards to the budget, we get any additional cheapening, as the market will have to price in more backdated issuance, and at the same time, a lot more linkers, which is very important for the level of yields.
Thanks, Theo, and I'm sure we'll discuss the budget next week in much more detail. But let's switch over to the US then, Blake. I know you've updated your forecast this week for even steeper curves, and just looking at the markets today, that's exactly what's happening. So can you talk us through the thought process there and what's kind of key this week?
Yeah, well, in a way, the market kind of forced our hand. We came into the year expecting higher yields, steeper curves, but it just happened a lot faster and a lot quicker than we had expected. A couple sources of that surprise, one obviously being results of the Georgia election, and really just kind of how quickly markets have kind of taken on that optimism around fiscal stimulus. And I would say also just kind of how well the data's done through the surge that we had kind of late last year into this year in COVID cases. A lot of the data we've gotten so far seems to have remained fairly resilient. And also, I think to some extent, we've seen the Fed pull back from this idea we had been kind of focused on, which is an extension of their maturity of their purchase program. So, start buying more long-dated treasuries to kind of push down yields at the back end of the curve. We didn't necessarily think they would do that, but it was something that was a very hot topic back in December of last year. And we had thought would kind of carry over into this year and continue that discussion would continue to keep some kind of lid on how much steepening and how much yield increase we would see at the beginning of the year. But we were kind of surprised on all those fronts. We've moved a lot quicker, a lot faster. So, once we hit those year-end targets, we were kind of left with the choice to either kind of get out of steepeners, reverse that call, start to fade, or extend. And I think just kind of looking at the landscape as it currently exists, it was a pretty easy choice to extend. This week specifically, I think is a very Fed-heavy week. We've obviously got Powell doing his semi-annual congressional testimony. First day of that was yesterday. We've got him back again today. We've also got Clarida and Brainerd today. So, really kind of the big Fed names are all speaking this week. Yesterday for Powell, I mean, he largely maintained the tone he'd had recently. I think emphasizing the need to continue to provide accommodation to the economy, continue to kind of downplay inflation risks, saying that the Fed would be very quick to look through anything that they viewed as temporary. And I think one thing that I at least noted was how frequently some of these like social issues came up. This is a topic and a theme that I've been talking about for a while now, which is that this increased focus by the Fed on inequality, both social income, is really going to affect the way they kind of behave into the next hiking cycle, basically delaying it, potentially flattening the next hiking cycle, and just seeing how much Congress really pressed on those issues, that reinforced that view. So we'll see what we get today from kind of the big three, and see if there's any change in tone.
Thanks, Blake. And I think, that one of the big themes of this week really is all about central banks. And when we talk about higher yields, how much we expect them or see them pushing back really on those high yields. So we'll come back to that after. Giles, I've just given you a chance to kind of update on the moves this week. I know we have similar views to Blake in the US. We expect yields going higher and steeper curves, as we've said many times on this podcast. And it has been another good week for those trades.
Yeah, I mean, I think that a lot of the focus this week has been naturally about about the inflation theme and so on. But there's also been a lot of focus about the way that that's being incorporated into the European thinking. I mean, break-even inflation actually fell over the last couple of weeks, let's say, and so a lot of people had highlighted, and we'll come back to this as you say, Imogen. They'd highlighted the rise in real rates as potentially a risk, and there was also quite a bit of focus, just on the breakdown of short-term correlations. This sort of, in the short term, typically bonds and stocks move in opposite directions. Is what we call a risk on, risk off, and that didn't work for a couple of days. I think that there's a very big picture story to tell one day about that, but it certainly got people talking about that just on a micro basis. I think that it's too early to really draw too much out of that. I don't think that's probably all that likely to be sustained. I mean, basically European rates have been outperforming US and UK, which I think is completely justified given events, data, politics. I mean, even the switch from extreme COVID pessimism in January to significantly more optimism, I think, has also been more of an Anglo-Saxon story than European, on both sides. I mean, excess pessimism and then much more optimism. So I think that's all in the mix. But overall, we do expect European markets to take all of this on board more seriously, and I think that there's probably some catch up to happen there. I mean, I guess that the color from discussions and also from our trading and sales has been that overall, although we have sort of plateaued a little bit, I mean, as in the sell-off has lost a little bit of its steam, it seems like there are more signs really of softness out there, difficulty in just seeing paper that as it's supplied to the market being fully digested, as you would say. You can see that in a few places, like for example asset swaps tighter. I think that's there have been some difficulties in liquidity and just around positioning in swaps, which feed into that. Also lighter supply this week just means less buying of paper on asset swap. So that was an interesting move too. I guess also just higher levels means increasingly potentially more bid for paper outright, and possibly even higher quality paper compared to spreads. So those are the main themes, I think, in the markets, just all gathered together.
Great, thank you. And I would say the real main question that we've been fielding from all of our kind of client discussions this week is just around, as I said earlier, to what extent, if we expect yields to continue to shift higher, and particularly in Europe where they've been outperforming, but we expect them to kind of catch up, to what extent do we expect the central bank to be okay with that, or even perhaps push back on that? We had a big response in European markets to Lagarde earlier this week saying that they're monitoring them very closely. Do you think we get anything more from the ECB, or do you think that is really the limit of their intervention, if you like, when it comes to particularly higher longer end yields?
Yeah, I mean, I think that the sell-off that the rally that we had on those Lagarde comments was told us far more about the way that the market was positioned than anything else. I also think it was because it just happened to be at the beginning of a week where people were primed to be looking for this kind of pushback, particularly because they knew that the very next day they had the bigger event in a way, which was Powell's testimony in the Senate. And yeah, so anyway, there's a big reaction on that, which wasn't really sustained. What does it mean? I mean, frankly, I don't think you could have expected her to have said any less, really. I mean, of course, she could have not said anything, but I don't think that was really on the cards. And the way I've been saying it is it seems like the market, when it comes to the ECB, always just wants to focus on potential triggers to get more intervention rather than just status quo. I mean, 6 weeks ago there was a lot of focus on the euro, which has obviously gone away, and now people are just noticing that we've had a little bit of a backup in yield levels and particular real yields. But in the scheme of things, this doesn't matter that much. I mean, the ECB, as it said time and time and again, we'll consider a broad range of indicators and a kind of scorecard. And I suppose that we'll probably hear more specifically about how they expect to sort of put those together in at the next meeting. At least that was the indication that we had back in January. For now, the measures that we have composed to try to track something which might be not too far from what they're thinking point to very, very easy financing conditions still, and really nothing that demands a response in the short term. And listen, we have the weekly purchases from the ECB, and we can see that in the last 3 weeks, their gross purchases have actually been week on week falling slightly. So this isn't something that's obviously going on at the minute. It'll be interesting to see if the evidence for this week, when it comes out, is any different. I suspect it probably won't. And I'll just say one more thing. I mean, the ECB doesn't have to tell us that it's going to do anything. It's got this huge envelope for its asset purchases, and it can and within that it can do almost anything it likes on a week-to-week basis, and doesn't really have to tell us about it. But I think that they will before meaningfully changing what they're doing, just because putting actions and words together is a far more efficient way of getting the outcome that you want than just throwing money at something.
Okay, so just to, I guess, round up that discussion on the European side before we flip back to US, because I do think that this is a global theme. But is there, for the benefit of listeners rather than me, is there a level or spread even perhaps for the ECB, which I guess is a bit different to the US? Is there a level of bond yields or perhaps a peripheral bond spread at which you think they might start to get more concerned and push back more heavily?
No, that's absolutely right. I mean, it's not just bond yields, obviously, that matter. I mean, they do care about spreads. We know that, we've seen that before, and in some sense, they probably care more about spreads than the risk-free rates. I think the line, and I'm sure this you'll hear from Blake in a second as well, but I think it also applies in Europe. As long as rising yields are felt to be justified by fundamentals, that in the way that they would talk about it, their language, endogenous rather than exogenous, then this is probably fine. And I think that at the moment you would link the rise in rates to greater confidence about recovery prospects, and so from that perspective, it's not something particularly to worry about. Is there a level? No, I mean, clearly there isn't a level. When you're looking at a scorecard of indicators, there's never a level on one individual thing. So you have to take into account how that affects the overall mix, I would say. But listen, I mean, just because everybody wants to hear what the level is, I would say, we've in the last few weeks we've been at all-time lows in real rates, and we're a little bit off that. I would say that nominal yields don't matter that much. It's all about real yields when it really comes down to it. And I could see those rising 30, 40 basis points in the right conditions before it's particularly a problem. I think it's also the speed of the move that matters. So they would lean, I would expect, against excess volatility. But even then, I don't particularly feel that we've seen that yet.
Okay, great, thank you. And just to flag as well that we should learn, or hopefully might learn, a little bit more about what they're really thinking in terms of financial conditions and how they define those in the March meeting. So I'm sure that's something we'll discuss in more detail on this podcast in the coming weeks. Okay. So over to you then, Blake, because it's not just been a European theme, it's definitely a global thing. Like you said, we had Powell's semi-annual testimony this week, or when we're recording this, we've had the first day. There were questions, around this that fielded to him. And like Lagarde, I would say he didn't push back too much on those. Is that in line with your expectations, or do you expect more questions to come today and then push back further, or do you think what he said was roughly right?
So yeah, I mean, just to kind of level set, yesterday he essentially repeated the language that we've been hearing for months out of most FOMC members, which is essentially that he's completely comfortable with where yields are, with what the curve has done, and that's because, as Giles was saying, I mean, this is what I've been kind of referring to as a quote unquote good rise in yields. It's been driven by those fundamentals that Giles mentioned. It's largely come on the back of expectations for fiscal stimulus, a development of vaccines, better data out of the US than expected. These are all the right reasons for a yield increase. And I think as long as that's what's been driving it, Fed's been totally fine with it. They've been very comfortable. And I think it also helps that when you look across this basket of financial conditions, which, much like in Europe, the Fed is very focused on a broad basket of financial conditions, not any particular yield level. And when you look across the rest of the conditions, this rally, the sell-off has been exactly what I think the Fed would have hoped for. It's been ideal. You've had equities rising, break-evens have been going up. Credit spreads have been tightening, kind of real borrowing rates for the economy have remained very low. Mortgage rates are very low. And as I said, credit spreads are very low. So borrowing rates still very accommodative. And real rates have remained essentially flat at near all-time lows. So from the Fed's perspective, this rise in nominal yields has not been troubling at all. I do think this last week has shifted a little. The tone was a little bit different this last week. So this was the first time we really saw real yields start to rise quite rapidly. I mean, particularly at the long end, we saw a very big rise in US real yields. We also started to see equities falter a little bit. Break evens actually fell. Inflation expectations started to back up for the first time. If you look at mortgage rates have just shot up. They were down near 280, up around 310, 315 now for 30-year mortgage rates in the US. So you're starting to see those, if you look across that broader basket of conditions, I think you're starting to see some signs over the last week that this last leg of the sell-off has not felt exactly the same as the one before. It's felt more like a bad sell-off. And I would note that also the conditions around that, Giles said fundamental, a fundamental based sell-off is really good one. This has felt a little more technical this last week. We've heard a lot of talk about convexity flows. We've seen some supply indigestion. Another thing Giles mentioned was spreads. We've seen spreads actually start to turn the other direction, particularly the long end, which could be a sign that markets are struggling a little bit to take down supply. We did have 10s and 30s 2 weeks ago, 20-year supply last week. So the market did take down a lot of long end supply and could be struggling with that. If those are the reasons that we've had, if we continue to have yield rises, convexity flows, supply issues, and those rises in yields are starting to kind of filter out to these other financial conditions, I do think the Fed will get worried, but it's still far too early for that, which is why yesterday, I think it was unsurprising that Powell basically just maintained the language that they've had for quite some time, that they're comfortable with this yield move. And I wouldn't be surprised if today he repeats that. I mean, he's probably going to be asked about this again. He'll repeat the same kind of language, and I wouldn't be surprised if Brainerd and Clarida in their comments today also, if it's addressed, they'll use a very similar tone, that they're comfortable with the level of yields, and a reminder that they look at a basket of financial conditions. But I do think it's fair, given what we've seen the last week, if this turns into a broader trend. 1 week is not enough, but if this continues for 3-4 weeks and we do start to see equities stumble, inflation expectations start to pull back, borrowing rates, credit spreads start to show that borrowing conditions are tightening up. That's the thing where I think the Fed may start to change their language. I wouldn't expect something as forceful as actually making a change to their asset program yet. But if they do change their language, if Powell and others start to say, we're concerned about where yields are going and what that kind of means for financial conditions, the market's going to read forward on that and say, well, if they're concerned, what are they going to do about it? The next step would be, altering their asset purchase. So even if they never get to that point, I think that's where the market's mind starts going, if we start to see that shift in tone from the Fed.
So that is your kind of playbook of how this would work out. You think it's more strong intervention, and then actual intervention would come via, announced shifts to their asset purchases rather than anything else.
If they were to take action, it would be it would be first through language, and hopefully that would be enough to kind of correct the issue. And if not, I mean, they can always back up that language with with asset purchases.
Fair enough. I presume, I know you've recently updated your year-end target for 10-year treasuries to 155. So we're only, 15 basis points away from that now. So
we might be there by the time this airs. So.
That's true. I should caveat that. But I presume obviously it depends around the drivers of the move. But even if we get there over the next kind of few weeks, that's not really a fast enough shift for the Fed to get worried about the kind of pace of rising yields.
I really agreed with what Giles said about pace being an issue. It's not just the level. I mean, I do think the speed at which we get there and kind of I want to say kind of the feel of it, the vibe of it. If it does seem like it's supply driven, if we're hearing about convexity flows and it's not, there's no real fundamental drivers that are clearly bolstering the move. We haven't gotten some big headline on stimulus or something like that. I do think that's going to be somewhat worrying to the Fed. And I would say what might be the ultimate trigger is more so than yields is something like equities. I mean, if a very sharp rise in yields starts to triggers a pullback in equities, we've seen in the past that the Fed for better or worse, does seem to be very responsive to large drop in equity prices. And that is always something that has seemed in the past to prompt them into action. So, it may not even be that there's some kind of nominal yield trigger or even real yield trigger that is a line in the sand that they want to protect. But if we see a very sharp, rapid move and equities start to pull back on top of inflation expectations, credit spreads, and other things, I think that's what would really prompt the Fed rather than any particular rate move.
Okay, great. So a lot to watch out for then in the next few weeks. I'm sure this discussion is one that we're going to come back to time and time again if yields do keep rising as we have in our base case forecasts. Okay, thank you everyone. That was nice to chat to you all this week, and we'll catch up next week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.